the PBOC could easily have acquired as much as 20,000 tons. It was at that point that the PBOC set up the Shanghai Gold Exchange, which is controlled by the PBOC, incidentally, so it's within the mandate of that original legislation in 1983, and allowed Chinese citizens for themselves to acquire gold. Now, when it comes to silver, it's a different situation. You didn't have a clearly a clear bear market, if you like, in the way we had in gold. Silver even then was behaving somewhat differently from gold as a monetary metal. But there is no doubt in my mind that there was a second program at the People's Bank of China to acquire silver reserves, if you like, which would be, like the gold reserves.
Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
Off to nobody knew where, and also the mining company got paid for it. So you've got three parties in this. You got the assessor, you got a bank, and you've also got the refiner. Now, in those days, and I think it's probably still generally true now, because refining silver, smelting it, refining and all the rest of it is a pretty, I suppose, environmentally unfriendly business. And it's quite energy intensive and so on and so forth. The Chinese were by far the cheapest and most ready refiners of silver. So all this doré was getting shipped over to China in order to be refined. So not only that, but China was something like the fifth largest mining nation for silver itself. So you can see that by taking on this role, it could quite easily accumulate all the silver that it would need to satisfy the monetary purposes which were intended in the original 1983 legislation. And I believe that's basically what has happened. So China has now got significant undeclared stocks of silver, and it will be, in terms of tonnage, considerably more than what they got in gold, obviously. So, the parties involved with this were Glencore, mainly. The bank would have been JP Morgan, I guess. And the other thing, of course, is that as the silver doré was taken on board, then that needed to be hedged in the futures market. And this is why you had JP Morgan appearing in the market, selling futures the whole time. And as far as the silver bulls were concerned, thereby deliberately suppressing the price. But it wasn't deliberate suppression at all in that sense. It was just part of the whole thing. I think it was intended to hit the price because as far as China was concerned, they wanted to acquire their silver without driving the price up. So I have little doubt that the management of the price was part of this whole process. So are they still doing it? Well, I don't see any reason why they should be still doing it. There may be an argument that they would want to keep the price suppressed because they're a major manufacturer as a nation and exporter of photovoltaic cells and other electronic goods which rely on silver. But that edge is going a little bit. I mean, India's sort of muscling in on the act and all the rest of it. And I think that just controlling the silver price purely for that purpose doesn't actually make an awful lot of sense. So my feeling is that the days of that suppression have probably come to an end. And I would expect, therefore, to see the silver price be freed, if you like, from this sort of suppressive intervention by China. I don't think they're doing it anymore. Which is interesting because it could well mean that as gold continues to to go higher. In other words, currency values continue to decline. On that basis, I would expect silver's got quite a lot of catching up to do.
In today's news recap, gold's meteoric rise pauses as investors consider profit-taking. Gold prices have experienced a remarkable upward trajectory since mid-December, culminating in a record high before showing signs of a pullback. The precious metal surged from $2,699.60 on December 18th to an all-time high of $2,974 yesterday, representing a 14.46% gain in just over 2 months. With the current rally approaching the magnitude of last year's advances, market participants have begun considering exit strategies. Commerce Bank analysts noted in a recent report that apparently these investors consider the upside potential of gold to be exhausted and are therefore taking profits. They cited the latest CFTC commitments of traders' data as evidence, which showed managed money funds reducing gold long positions by nearly 12,000 contracts. Despite a substantial net long position exceeding 200,000 contracts remaining, this reduction signals potential exhaustion in gold's upward momentum. Market sentiment appears to reflect that gold had become overbought following its recent parabolic surge. However, today's price decline occurs against a backdrop of escalating trade tensions, as U.S. President Donald Trump announced plans to impose a 10% tariff on energy imports from Canada, along with a 25% levy on goods from both Canada and Mexico, America's two largest trading partners. These import taxes, combined with the existing 10% tariff on Chinese imports, are expected to hamper global economic growth and suppress demand. Analysts at Saxo Bank observed that safe haven demand remained strong amid tariff concerns. President Trump confirmed tariffs on Canadian and Mexican imports will proceed, keeping inflation and trade war risks in focus.
There is, I think, growing fears that not only is the economy stalling, but it is going to go into a slump. Now, if that happens, then this budget deficit is going to soar, simply because revenue is going to decline. And while revenue declines, you'll also find that welfare payments and all the rest of it increase. Government finances are going to be in a huge, great mess. And then put on top of that Trump's tariff policies, that beautiful word, tariffs. And you've got an absolute classic doppelganger for the 1929 to 1932 period, when you had the combination of a bubble bursting, the bubble which was engineered by the Fed, incidentally, under Benjamin Strong in the late 20s. And at the same time, you have the Smoot-Hawley Tariff Act, which was passed in 1929 and then enacted into legislation by President Hoover in 1930. We've got exactly the same thing today. And look what happened in the 1930s. Something like 5,000, 6,000, 7,000 banks went bust, which is why actually, the credit actually contracted, because it just got wiped out. So, with the prospects of that, with a few extra things like, we've got supply chains around the world now, which we didn't have in the 1930s. Breaking those, I mean, they're already being fractured, but breaking those, I think, is an extra dimension to the whole problem. The rest of the world is going to go into a slump as well. The tariffs against Canada and Mexico are reaffirmed this week, and it looks like the EU is also going to be hit with 25% tariffs. This is Smoot-Hawley Mark II. This is the Wall Street crash Mark II. We're talking about a combination of these economic events, which are completely unavoidable, coupled with the collapse of credit. Or if you like, you probably understand this more by calling it the collapse of the value of the debt, because the debt is the other side of credit. That's really what the credit bubble is. It's the other side of debt. So this is going to be a big reconciliation. And anyone who is in credit, I think, is going to, which we all are. I mean, we use credit. We don't use money. We don't do transactions with gold. It's all credit. that is going to be a major, major problem. And I think that the Fed's mandate under these circumstances is quite clear. Don't defend the currency. Try and defend the banks. Stop the banks going under. Stop the whole of the derivative system. You know, we're talking about hundreds of trillions of dollars worth of obligations, which again are debt on one side, credit on the other. Stop them collapsing. You don't want counterparties in those chains going wrong. The whole thing is actually looking extremely dangerous. And that was the whole point of my article, to draw attention